Welcome to Investor Web, the go-to channel for all things finance and investment. We're here to help you navigate the ever-changing currents of the financial world. Our channel covers a broad spectrum of topics, from in-depth investment advice to the latest market trends. We are dedicated to debunking myths and outdated rules that can limit your financial growth. We understand that the world of finance can seem complex and intimidating, but we're here to break it down for you, making it simple, clear, and accessible. Whether you're a seasoned investor or just starting your journey, you'll find our content insightful and empowering. In our pursuit to provide you with the most relevant content, we've embarked on a mission to expose the 10 most outdated money rules that might be holding you back. Today, we delve into the realm of outdated money rules, so buckle up for an enlightening ride. Let's kick things off with the first outdated money rule: saving is enough. For many decades, this principle ruled the roost. Stash enough pennies under the mattress and you'd be set for life. However, in today's vibrant, fast-paced economy, simply saving is akin to parking your money in a static place. It does not grow, it doesn't multiply, it just sits there, losing value due to inflation. Now, don't get me wrong, saving is crucial. It provides a safety net for unpredictable life events, but it's just the starting point. The true power lies in investing and growing your wealth. Through investments, your money works for you, even when you sleep. It's like planting a seed that grows into a money tree over time, providing you with a steady stream of income. So it's not just about saving, it's about growing your money wisely. Stay tuned for more outdated money rules that need a serious rethink in the modern financial landscape. Next on our list is the rule that states home ownership is a must. This rule seems to be etched into our collective consciousness, but let's take a moment to challenge it. Buying a home can be a significant financial commitment, one that might not always make the most sense. Consider the costs of home ownership: mortgage payments, property taxes, insurance, and maintenance. These can add up quickly, and they're not always outweighed by the potential increase in home value. On the other hand, renting can offer more flexibility. You're not tied down to one location, and you're not on the hook for those pesky maintenance costs. Plus, the money you save by not making a down payment can be invested elsewhere, potentially providing a better return. But let's be clear, this isn't a one-size-fits-all rule. For some, home ownership is indeed a good fit, but for others, renting might be the more financially savvy option. Remember, owning a home isn't always the best financial decision. It's all about what suits your lifestyle and financial goals. Third on our list is the belief that you need a high income to invest. This idea, common in the past, is no longer applicable in our current financial landscape. The rise of micro-investing platforms has democratized investing, making it accessible to all, regardless of income level. These platforms allow you to invest with as little as the price of a cup of coffee. Starting small is the key. It's not about how much you invest initially, but about developing a consistent habit of investing. Over time, these modest contributions can grow into a substantial portfolio. It's all about leveraging the power of compound interest, where your earnings generate even more earnings. Remember, every investor started somewhere. Even the most successful investors didn't start with millions. They made small, consistent investments and let time and compound interest do the rest. Investing isn't only for the wealthy. Every penny counts when it comes to growing your wealth. Fourth on our list is the rule: keep all your money in one place. This rule may have made sense in the past when banking options were limited and the financial landscape less complex. However, in today's world, it's a rule that could limit your financial growth. Why? The answer lies in one word: diversification. Diversification is the practice of spreading your investments around different types of assets to reduce risk. It's like not putting all your eggs in one basket. If one investment doesn't perform well, others may do better, balancing out your overall returns. There are several ways to diversify your portfolio. You can invest in a mix of stocks, bonds, and mutual funds. Each of these asset classes has different levels of risk and return, offering a balance between risk and potential reward. So, the next time you think about where to put your money, remember, diversification isn't just a fancy word, it's a crucial strategy in wealth management. Halfway through our list, we encounter the rule, investing is risky, avoid it. A statement that's as misleading as it is outdated. Yes, investing comes with risks, but so does crossing the street. It's not about avoiding risk altogether, but understanding and managing it. In the realm of investing, risk and reward are two sides of the same coin. It's a dance of potential gain against potential loss. High-risk investments can lead to high returns, but they can also lead to substantial losses. Conversely, low-risk investments may offer more stability, but the returns are typically lower. The key here is understanding your own risk tolerance. Are you a thrill seeker willing to risk more for the potential of higher returns? Or do you prefer a slow and steady approach, prioritizing security over rapid growth? Making informed investment decisions based on your risk tolerance and financial goals is crucial. Investing does carry risks, but avoiding it altogether may be the bigger risk. Sixth on our list is the belief credit cards are bad. This outdated rule has painted a picture of credit cards as financial boogeymen lurking in the shadows, waiting to trap the unsuspecting in a cycle of debt. But let's debunk that myth right here, right now. Credit cards, when used responsibly, can be a powerful tool in your financial arsenal. They can help you build your credit score, which is crucial for securing loans or mortgages in the future. Plus, many credit cards offer rewards such as cashback, air miles, or points that can be redeemed for goods and services. The key word here, however, is responsibly. That means paying your balance in full each month, not spending beyond your means and being mindful of interest rates and fees. Essentially, it's about treating credit cards as a tool, not as an unlimited money supply. Credit cards aren't the enemy. Irresponsible usage is. Seventh on our list is the rule, always buy new. A rule that has seen better days, and for good reason. In the modern age, the benefits of buying used items can far outweigh the desire for the untouched and the shiny. For starters, let's talk savings. Buying used often means paying a fraction of the original cost. That's money that can be put towards investments, emergency funds, or even just a well-deserved treat. Then there's sustainability. In a world increasingly aware of our impact on the environment, buying used is a step towards reducing waste and conserving resources. It's a small part we can play in a larger global effort. And let's not forget quality. Many used items, whether it's a car, a piece of furniture, or a designer handbag, still have plenty of life left in them. Often, they've been well cared for and are in near perfect condition. Use doesn't always mean abused. It can also mean savings and sustainability. Eighth on our list is the rule: you should retire at 65. This rule hails from a time when life expectancies were shorter and pensions were the norm. But as we live longer and healthier lives, this rule is becoming increasingly outdated. The retirement landscape is shifting. More people are choosing to work beyond the traditional retirement age of 65, and they're reaping the benefits. Working longer can mean increased savings. It gives your pension pot more time to grow and ensures you have a larger nest egg when you do decide to retire. Beyond the financial benefits, staying in the workforce can offer social engagement and a sense of purpose. It keeps you active, mentally sharp, and connected to your community. So, don't let an outdated rule dictate your retirement plans. Remember, retirement is about more than just age. It's about financial readiness, personal fulfillment, and lifestyle choices. Retirement is a personal decision, not a number. And ninth on our list is the rule: you need to keep a minimum balance in your bank account. This rule has been around for ages, suggesting that you must always maintain a certain amount of cash in your bank account. However, the world of banking has evolved significantly. In the past, keeping a minimum balance was necessary to avoid fees or account closure. But today, many banks, especially digital ones, have changed their policies. They now offer no minimum balance accounts, providing flexibility for people who don't want to be tied down by a specific cash reserve. But remember, it's essential to choose a bank account that suits your financial needs. Some accounts may offer attractive perks for maintaining a higher balance, such as higher interest rates or waived fees. It's all about weighing the benefits and finding what fits your lifestyle best. So the bottom line, with the right bank, you don't need to worry about minimum balances. Last on our list is the belief: gold is the safest investment. Now, who doesn't love the idea of a treasure chest filled with gold bars? But let's be real, folks. This notion has been around since the days of pirates and buried treasures. Today, investing solely in gold is as outdated as the maps they used. Gold, like any other commodity, is subject to price fluctuations. While it's true that gold has historically held its value over the long term, it's equally vulnerable to sharp declines. The gold market is highly volatile and the prices can swing drastically based on global economic conditions. Here's a simple truth. There's no such thing as a safest investment. Risk is inherent in all types of investments. That's why it's crucial to diversify your investment portfolio. Spread your eggs across different baskets: stocks, bonds, real estate, and yes, even a bit of gold if you like. Gold may glitter, but it's not always gold when it comes to investing. We've covered a lot of ground today, debunking 10 outdated money rules. We've seen how saving alone is not enough, and how the must-have dream of home ownership can sometimes be a myth. We've examined the misconception that a high income is a prerequisite to invest, and talked about the risks of keeping all your money in one place. We've debunked the myth that investing is too risky, and explored why credit cards aren't always the villains they're made out to be. We've challenged the idea that everything must be bought new, questioned the traditional retirement age of 65, and explored why keeping a minimum balance in your bank account may not be necessary. Lastly, we've looked at why gold isn't always the safest bet for investment. These discussions encourage us to question traditional money rules and make informed financial decisions. Thank you for joining us on Investor Web. If you found this video helpful, don't forget to hit the subscribe button and stay tuned for more content. Remember, the key to financial success is staying informed and adaptable.